Imagine walking into your local community bank, not to fill out paper forms, not to wait days for an answer, but to receive a fully automated credit approval in minutes. Not from a person, but from an intelligent system that reads financial histories, evaluates collateral, predicts risks, and delivers a recommendation that's as reliable, or sometimes more reliable than a human analyst. This isn't science fiction, it's happening now. In early 2026, a Boston-based startup called EnFi secured a major funding round to bring this future closer. And today, we're breaking down what this means for banks, borrowers, jobs, credit decisions, and the future of finance as we know it. Stay tuned, because these developments aren't just changing banking, they're rewriting the rules of financial decision-making. What is EnFi and what did they raise? In February 2026, EnFi, a Boston-based fintech startup, announced that it had successfully raised $15 million in new venture funding, marking a significant milestone in its growth trajectory. The funding round was led by FinTop, a well-known investor in financial services, technology, with participation from Patriot Financial Partners, Commerce Ventures, Unusual Ventures, and Boston Seed Capital, firms whose combined networks extend across more than 150 financial institutions, primarily regional and community banks across the United States. This investment is not just a standalone event, it is part of EnFi's broader financing journey, bringing the company's total funding to approximately $22.5 million to date. For a startup operating in the highly regulated and traditionally conservative banking sector, this level of backing signals strong confidence from investors who deeply understand the structural challenges of modern finance. But what makes EnFi particularly compelling to these investors, and why is this funding happening now? The answer lies in a growing imbalance within the banking industry. Smaller and mid-sized financial institutions are under intense pressure. They face increasing competition from large national banks and fintech giants, all while dealing with a severe shortage of experienced credit analysts, rising operational costs, and stricter regulatory expectations. Hiring and retaining top-tier talent has become both expensive and difficult, especially for regional banks that lack the scale and resources of their larger competitors. EnFi positions itself at the center of this problem. Rather than asking banks to simply hire more people, the company proposes a different solution: augment human expertise with AI-powered credit analyst agents that can operate at machine speed while maintaining institutional consistency. This promised efficiency without sacrificing judgment is what makes EnFi stand out in a crowded fintech landscape. In other words, investors are not just betting on a product, they are betting on EnFi's ability to become a critical layer in how smaller banks survive, compete, and make credit decisions in an AI-driven financial system. A deep talent gap in banking. Across the United States, regional and community banks are facing a problem that's been quietly growing for years: a chronic shortage of skilled financial professionals. One of the most affected roles is credit analysts, the people responsible for reviewing loan applications, interpreting financial statements, assessing borrower risk, and ultimately deciding who qualifies for credit. According to EnFi's co-founder and CEO, Joshua Summers, this shortage is no longer a temporary hiring challenge. Many banks are routinely forced to leave thousands of credit analyst positions unfilled, not because they lack funding or demand, but simply because there aren't enough qualified candidates entering or staying in the field. Training takes time, experience is hard to replace, and burnout rates in manual credit analysis roles remain high. Now, consider the consequences of this gap. Every unfilled role means slower loan approvals. Every delay means frustrated customers. Every bottleneck means missed revenue. For smaller and regional banks, the impact is even more severe. While large institutions can absorb delays with massive teams and automated infrastructure, community banks often cannot. They lose potential borrowers to bigger competitors, struggle to serve small businesses efficiently, and watch millions of dollars in lending opportunities slip through their fingers, not due to poor risk management, but due to limited human capacity. Imagine a small business owner waiting weeks for a loan decision, a family delaying a home purchase, a regional bank watching customers walk away simply because decisions can't be made fast enough. This is not a hypothetical scenario, it's the everyday reality for many institutions operating under staffing constraints. And this is precisely where EnFi's AA Satu credit analyst agents enter the picture. In a banking environment where speed, accuracy, and scale increasingly determine competitiveness, AI1 is no longer a futuristic upgrade. For many banks, it's becoming the only viable solution to a growing talent gap and a fundamental shift in how credit decisions are made. What are AI1 credit analyst agents? So what exactly is an AI1 credit analyst agent? In simple terms, these are advanced artificial intelligence systems trained to perform the same kinds of tasks that human credit analysts do, but at scale and much faster. These AI1 agents can review financial histories of borrowers, evaluate leverage and debt ratios, analyze collateral quality, assess risk profiles, flag inconsistencies in documentation, automatically generate credit recommendations. In many cases, the agents get better over time, tailoring their analysis to each bank's unique credit portfolios. This means the more data they see, the more accurate and useful they become. This technology doesn't just evaluate numbers, it performs tasks that once required hundreds of hours of meticulous human effort instantly. That accelerates lending, reduces bottlenecks, and helps small banks compete more effectively with larger counterparts. Why this matters for regional and community banks. For large national banks, deploying advanced analytics and automation tools has been underway for years. But for smaller regional and community banks, the backbone of many local economies, these technologies were historically out of reach. Smaller banks often lack the capital to build proprietary systems, the talent to manage complex data, or the infrastructure to deploy AI at scale. Now, with AI credit analyst agents offered by third-party providers like EnFi, these smaller institutions suddenly have access to enterprise-grade automation without having to build it from scratch. This levels the playing field. Instead of waiting weeks for a credit decision, losing business to bigger banks, overworking existing staff, smaller banks can now process applications faster, more consistently, and with less manual labor. This transforms lending from being a capacity-limited business into something much more scalable and competitive. And that's a big deal in the financial world. AI1, agents as co-workers, not replacements. One of the most important aspects of this technology is how it's positioned in relation to human staff. EnFi's leadership emphasizes that these AI1 agents aren't there to replace humans, they're there to augment them. Instead of forcing analysts to choose between processing fewer loans, lowering underwriting standards, or burning out their teams, AI1 can act as a virtual co-worker, handling repetitive or analytical tasks that bog down humans, while allowing real professionals to focus on judgment, oversight, and relationship building. This model, where technology expands human capacity instead of replacing it, is critical in financial services, where accountability, oversight, and regulatory compliance still demand human involvement. It's a future where human expertise and machine efficiency work in concert, not in competition. And that's why investors in this space see AI as an enabler, not a threat. Broader industry trends and implications. EnFi's funding round isn't just a one-off event. It's part of a broader industry trend where AI systems are being integrated deeply into financial workflows. Financial institutions are increasingly under pressure to reduce operational costs, increase speed of service, improve accuracy and risk management, offer personalized, data-driven insights to customers. AI1 is uniquely positioned to address these challenges, from fraud detection to underwriting, from risk scoring to portfolio optimization. And credit analysis is just one of the fastest-growing areas. NFI's success reflects this broader shift. Major voices in finance have recently pointed out that AI needs to be handled responsibly, with transparency, governance, and reliability at the core, especially as these systems move into regulated banking environments. This means that while AI1 can speed things up, banks also must ensure they comply with regulations and maintain trust with their customers. What this means for you. So what does all this mean if you're a customer, a business owner, or someone thinking about a loan? Faster decisions for credit approval. Complex analysis can happen in real time. More competition among lenders. Smaller banks can compete with larger ones. Potential changes in job roles. Analysts may shift towards oversight and strategic work. Greater access to credit, especially in underserved markets. Banks that adapt quickly could dominate their markets, while those that don't may struggle to keep up. And for everyday borrowers, it may soon become normal to get faster, smarter, and more transparent credit decisions powered by AI. If you found this video insightful, give it a like, subscribe for more AI plus finance updates, and tell us in the comments, do you think AI credit analysts should replace human decision makers? Or should humans always stay in charge? Thanks for watching and see you in the next video.